Hey guys, this is Scott Horne for the Owner Finance Network. We're going to take a little bit of time in this video and talk about wraparound mortgages, what they are, how they work, what they mean. Don't pay attention to this cup. This is really my business partner's cup because she's at least that old. I'm not nearly that old, by the way, y'all. And I'm full of a lot of things also. So basically, what is a wraparound mortgage? A wraparound mortgage is a mortgage that is created, it's a brand new note in deed of trust, but it is subject to an underlying lien. And that's why it is called a wraparound mortgage, because it literally wraps around the first lien mortgage on the property. And a wraparound loan is actually called a subordinate lien. It's not a second lien, it's just called a subordinate lien. The best way to understand a wraparound is the flow of money, and that's where the borrower under a wraparound mortgage pays the lender, the seller, and the seller then pays their underlying mortgage company. That's kind of the best way to understand the flow there. And there's a time and place to use wraparound transactions. If I'm buying a home from a seller, a lot of times we want to buy a home subject to the existing debt if there's an existing mortgage on the property. There's many good reasons to do that over and above a wraparound mortgage, but oftentimes a seller does not want you to buy their home and not pay them off in 27 or 28 years or whatever it might be for the time left on the mortgage. Maybe they want you to pay that loan off in 3 years or 5 years or 10 years, and that works for your investment strategy. Well, you can't go in and modify the borrower's mortgage with their mortgage company. You don't have the ability to do that. The only way to do this is by doing a wraparound mortgage, which can be for the exact same terms and conditions of the underlying lien. We call that a mirror wrap. It could also be for a little bit higher interest rate or a little bit higher principal based on the situation. But by doing the acquisition wraparound mortgage, it allows you to put a balloon vehicle into that transaction. So let's say, for example, the seller has 25 years left on the loan. It's a 4% interest rate at $100,000. You do a wraparound mortgage at $100,000 at 4%. You use the same monthly payment on a 25-year amortization, so everything looks exactly the same, except now maybe the seller wants you to pay that loan off in 5 years or less. So we build in a 5-year balloon vehicle. You've solved the problem. And by the way, guys, think about this. If you're making your payments on time, taking care of things, there's a good chance that the seller might renew and extend that loan for an additional term. Maybe they like that income coming in. Maybe they see that you're doing the right thing and taking care of things and paying your bills timely, and they're happy with all that. And maybe before you just go in to pay off that property or sell it, you ask the simple question, would you be willing to renew and extend this for another 3 years or 5 years based on what the case might be? All things are possible. And guys, there's an old adage, if you don't ask, you don't get. So another way to use a wraparound mortgage, of course, is when we're selling a home, either to a back-end investor or typically to a consumer or a home buyer who's going to live in that house. And you can do that wraparound mortgage whether you bought the home subject to the existing debt, whether you bought that home from a seller with a wraparound mortgage, or whether you went to a local bank or mortgage company or DSCR lender and borrowed a loan where you're going to sell that house. So why would I want to do that? Well, I want to do that usually because I can get a higher sales price, number one. I can get a higher interest rate, number two. I can oftentimes sell my house with a little bit less work done to it as I'd have to do if I'm going through a true retail perspective along the way. And it gives me, I think, a lot more exit strategies in that my buyer could refinance and pay me off. That would be great. I could sell the mortgage to a note buyer, as we call it, into the secondary marketplace. We call that a note sale. And in fact, I think that's one of the ways to really generate wealth in our industry, because I can show you that if you are able to buy a house and sell it for 110 cents on the dollar, put some money down when you buy the property, sell it for your 9% interest rate, let's say, for example. You take the income and you apply it to your debt over 2 years. In 2 years, you can, again, usually almost always 2x, but usually 3 or 4x your profit if you just did a basic fix and flip. And it's truly how you can make that much more money on one property is how you generate wealth. Wouldn't you want to be able to make 3 or 4 times more money on one deal than you would normally? Because there's no way to invest the profit you make doing a fix and flip on one house and make 3 or 4 times that amount in a very short time frame, like 2 years. And so learning how to play that finance game is so important, and it's how we incorporate the wraparound mortgage in that role. Now, if we're selling a home to a homeowner, to a consumer as we call it, remember, most likely you're going to run that buyer through a loan processor. We call that the residential mortgage loan originator. And they're going to process that buyer like any other mortgage company out there. They're going to provide you a loan package that allows you to review that to ensure that you can approve your buyer for the sale. Of course, what you're looking for there is the buyer's ability to repay the loan and ensure that they have a reasonable debt-to-income ratio. Guys, somebody has a 30% DTI, as we call it. Okay, that's pretty reasonable. But if they have a 70% DTI, the bottom line is they can't afford your house. And so it's being smart in how you look at those kind of things to make the right and the best decision. And oftentimes your RMLO will help you navigate that if you take time just to ask them along the way. When you're doing a wraparound mortgage, it's important to know what kind of documentation you're going to be using. You're going to be using a wrap note, a wraparound deed of trust, a deed that has the wraparound provisions in it also. We are disclosing the underlying debt in those legal documents. It's important to know what are the requirements in your state for any disclosures with your contract. Here in Texas, we have the Texas underlying lien disclosure notice and finance disclosure notice that must be given to a buyer both in Spanish and English at bare minimum. And your state may have things very similar to that along the way. So make sure you know what those are. Know at the closing table what kind of documents you need to be looking for and make sure they're there. And again, this business is all about disclosure. 90% of the wraparound business, proper disclosures in your contract up front, even disclosures at the time of closing to ensure that both you and especially your buyer understand there's an existing mortgage, that they understand there could be a due on sale clause in that mortgage and what that means, and how to navigate that appropriately to let them understand that they need to be paying their payments on time, working with and incorporating a loan servicer so that that buyer pays the loan servicer pays your mortgage company first, and pays you whatever is left over in the end. We kind of call that our fraud preventer in the industry, because now if the buyer should ever default and not make payments, it's not because they paid you and you pocketed that money, didn't pay your lender, it's because they didn't make their monthly payment. Pretty common sense when you look at things out there in that regard. Again, when you do this with your back-end buyer, they most likely can obtain title insurance if they wish to do so. You can negotiate your closing costs with them. Usually the buyer pays all the closing costs in these kinds of deals, but not always. If you got a good buyer and a good down payment, maybe you might be willing to split those with them somewhere or even pay them based upon various circumstances. All things are possible and all things are negotiable in this regard. So guys, I hope you found this video helpful. If you did, take a minute and like it, please. If you got any comments after you listen to this, please comment below. We'll do our best to answer those for you. And then along the way, please go and join our YouTube channel as well. We'll see you all next time, guys.